All right, Mark, did you know that Americans haven't paid as high of prices per household income in the last 30 years as they do right now? So put this in
As-
perspective. Last time, early 90s, where were you?
Where was I in early 90s? Wow. Well, my hair was dark like yours, Rob. That was kind of fun. I was, yeah. So had a couple kids and three maybe. And out of our five, playing for New York, I was with the Jets at the time. And Bush was
Very
the
cool.
president back in the day. Had
Yep.
the mullet going.
Yep.
Sweet. That's great.
Rocking the mullet.
So we haven't, since that period of time, like the percentage of our money that goes our expenses is not towards food is in now as high as it was then. Yeah, it was pretty expensive then, but the prices were a lot lower. I'm just telling you right now,
Right.
prices were a lot lower, but in relation to the percentage of what it took to get there, yeah, I get that. And then today, man, it's ridiculous what's going on. I mean, it's unbelievable how much everything's gone up.
Yeah.
And the
So price.
crazy thing is too, you got to tip everybody for even like when you walk. It's like a whole different deal,
It
which
is.
is like that's a whole. So it just
That's an
makes it.
extra 15 to 20%, depending on how much you're liking that person or that
You, have to,
restaurant on that specific day.
you go to get coffee, right? And you get whatever, and you just like, and then you feel like I can't put no tip, but sometimes
Right.
you do, and then you think, what is that person across? Like, what does that person think of me right now? Like, you're such
Right.
a loser. You didn't even tip me. I
I
mean,
know.
like, I never tipped you before. But all of a sudden, I'm supposed to tip you. Like, why am I? You know what I mean? Like, you walk out with your coffee, you're all feeling guilty and stuff. I don't know. It's just a weird
It
time.
is. It's just new. I think it's just new for us. It's like we never had this option before, and now, and service industry obviously should get tipped. If you're waiting tables or
Oh
taking
yeah.
orders and you're doing a lot of work, we're not arguing that. But it's just funny when you're
No,
walking
no,
out,
it's
you're like,
funny.
do
I'm
I
saying
do it
like
or do I not do it? And I feel like junk.
I'm I'm doing all the work here. I came out. You can do anyway. It's yeah, whatever. So
So
anyway,
so so
but
percentage of
everything's
household
expensive.
in right. And so percentage of household income, which you're talking about, over 11% of your total household income is going towards your grocery bill. I mean, that's just a fact. It's crazy. So if we average out those prices, to average household prices for groceries and the price change from January 2020, you're looking at groceries up over 25%. Dining out up over 25%. That's become a luxury. You
Yeah,
just ate out, right? You saw
yeah,
it. I've eaten
yeah, yeah,
out in
yeah,
the last week. It's crazy. I mean, prices
yeah,
have gone up exponentially.
yeah. No, it's
And
crazy. I feel like for you guys, young families, different things. Just it's very interesting to see how expensive things are, and it's tough, man. It's tough on. Yeah, you got kids, the whole bit, trying to make it, and it's a tough time. Yeah, it's tough, and a lot of that popped up, right? COVID and happened,
Mhm.
and a lot of things seemed that when we went sideways and backwards with COVID.
Free
A lot of
money.
things, there was a lot of things that kind of rolled in that now we are still doing that, that kind of just, prices ramped way up, and it's this idea of disinflation versus deflation, so
Mhm.
yeah, so like today we're going to talk about interest rates, what the Fed said, but hey, inflation's coming down towards, is it going to come back to 2%? Well, it's still, that's disinflation when it's actually still going up, but just lower than it has, right?
Right.
Deflation was the prices actually drop. So we're not talking about deflation trying to drop those prices. So point is, once the prices go up, they get really sticky, and sometimes, a lot of times they don't go back down.
Right.
So that's a big, again. So a lot of these things were just it kind of is what it is at the moment. See how it pans out.
That's a good point. I think a lot of people are thinking, oh, like I'm waiting for the prices to come back down. And while that can happen, but again, in a long period of time, deflationary numbers are not good for anybody. What you want to see is disinflation, like you had described, right? Like you want things to go up at a slower pace, right? Obviously, the cost of goods over long periods of time go up. So,
Yeah, I mean, I wouldn't mind seeing deflation in some of the stuff. I mean, I don't
yeah,
know.
for the near term, right, to get those prices back down
I
for
mean, the
sure.
prices of homes, I've been through cycles where I've seen home prices come down. Um, and I don't know that we're going to be there anytime soon, but that it happens, and it's not the end of the world. It's a whole different set of issues that come with deflation. But
Yeah.
right now, we're just talking about disinflation. So back to the point. It's an expensive time to live, and it's yeah, it makes it tough on families, especially.
So today, Fed Chair Jay Powell came out and talked about how they're going to pause interest rates, right? They're going to continue the pause. And this is the fourth pause in a row. No change to how many rate cuts they're forecasting this year. Still 325 basis point rate cuts, excuse me, this year. What did change a little bit was 2025% or 2025, excuse me, rate cuts, like how many they're forecasting in 2025. And that went from 4 to 3. So less rate cuts next year. This year, still the same amount they're projecting. Hopefully, they're thinking sooner than later. But again, we've talked about this a lot, the balancing act of cutting rates too fast, too much, and kind of resparking that 70s inflationary fear that a lot of people, you remember,
Yeah.
grandparents remember, whoever it
Yes.
is going through that
Yeah.
time, you remember
Yeah.
that. So uh, can you maybe talk a little bit about expectations? So do you think, let's put it this way, do you think that the Fed's going to raise their target inflationary number from 2 to 2.5, 3? But they're not going to give that away now, right? They're not going to do that now because that's going to make them look stupid. But do you think that could potentially happen instead of us making it all the way back down to 2%?
So that's a great question. I don't know if you remember, Jason, but over probably a year ago, I think we were doing this, and I talked about how the fact was that long-term inflation has been historically as high as like 3.5, 4% a year over a
Mm-hmm.
long period of time on average.
Yeah.
So my point was, that might be where we end up, kind of 3, 4%. And now,
Mm-hmm.
but for whatever reason, the Fed has had this 2% goal. And that goes back a number of years at 2%. But anyway, I guess all that to say is that you're asking me that question. And I was even a long time ago thinking that it would be, they might, they're gonna talk about this 2%, but I think they just want it to be below 4. I
Yeah.
mean, and I know that sounds really crazy, but yeah. So the answer to your question, yeah, I think they could change that, but they're never going to talk about changing, and that would be a
Mm-mm.
totally different deal. So they're going to keep pressing for 2, but I don't know that we're going to get there, frankly, unless, of course, this thing, this economy falls off more in the second half of the year than everybody's expecting, which is possible. I mean, there's some
Yeah.
underlying numbers in the data that's coming out that's saying, hey, yeah, jobs are good, lots of, employment, things like that. And, prices are high, but there's some other, debt issues and things that you're seeing that could be that this thing doesn't fall off a cliff. I'm talking about the economy, but it could go into a recession later this year. Then what? Then the Fed, now you're talking about pricing in a couple rate cuts this year,
Mm-hmm.
which again, we had talked about higher for longer a long time ago, and it's like, so that's kind of playing out the way we thought. But how about if it kind of rolls over a little bit close into the year and all of a sudden they have to be more aggressive? There's a lot of things on the table here that are really interesting, to see how it's going to play out. It's a very interesting time, in the economy for sure.
Yeah, it definitely is. And I want to show real quick a little chart here. We're going to pull it up and we're going to talk about the uh, the charts that kind of describe what Jay Powell did or what he was saying and how the markets reacted to it. So I'll pull that up here so our viewers can see, and then we'll just verbalize it for our listeners here. So let's first talk about markets here, Mark. So the markets,
Is this today?
and this is today. This
Yeah.
is today. This is March 20th. So this is prior to Powell
So,
speaking, and then
yeah.
this is after, during, and after him speaking. We hit all-time highs, the Dow and S&P, Nasdaq, not all-time highs, but closing high for sure.
Closing high.
Yep. And so it's quite interesting, right? So Powell's tone again, rate, inflation reared its head again the last 2 months, came in hotter than expected. There are going to be bumps in the road, he said. And this is one of those times. And we agree. We think there are going to be bumps in the road. We think, that potentially this could be a little bit more of a bumpy rate cut scenario. Again, potentially, we don't know what's going to happen short term. Depends on the economy and how it reacts and how all this is baked into the cake here, into the markets. But we could get couple rate cuts, and then we could see inflation start creeping up again over 3-6 months, and then the Fed's like, oh, we need to raise rates quarter basis point to hopefully taper that off a little bit. But it's going to be a balancing act, right? So quite interestingly enough, we got indexes going up today after that. They were very muted or even down, market open. We had Treasury note, which again, I want to get your thoughts on currency and gold here in a second. Okay. That's really interesting to look at. 10-year Treasury note here. Pretty, it's obviously moving, 10 basis points, potentially 5 basis points, depending on where we're looking at here. But I mean, you see these slopes, and it kind of moves sideways throughout the day. And then as soon as Powell starts speaking, boom, we get the yield dropping and then shooting up to over 4.32%, and then coming back down to earth, kind of where it was throughout the day, and basically finished flat around 4.28% on 10-year Treasury note. So getting pretty volatile when he's talking, trying to figure out where we're going with interest rates. And then we get
Crazy.
into
It's just a side note. I'm thinking about
yeah,
looking at these charts, like how important. So we knew they weren't going to change rates today, but everybody was waiting to just listen to Powell. And it's just crazy to think of how much. I mean, dude, when he talks and if he says the things that everybody wants to hear, the market makes a cajillion dollars. You know what I mean? The
yeah,
move up, right? It's like, it's
mm-hmm.
like the old E.F. Hutton. When E.F. Hutton speaks, man, everybody's listening. It's like,
Yeah,
it's crazy the power of the right in some ways, but it's the reality of it.
yeah,
And
moves
name
markets.
respect. Yeah.
Absolutely. We had crude prices come down a little bit. But here's the big thing we want to look at. So gold, continuous contracts shot up quite a bit here for a troy ounce of gold. And then we had the dollar index collapse a little bit, not collapse in terms of, catastrophic
No, but it's dropped. Yeah.
numbers, but for the day, the chart doesn't look great. So, can you talk a little bit about the parity, the difference between maybe what people are looking at when you see the gold spike and then you see the dollar index crash? Why are they moving opposite? Some people might be thinking.
I mean, lots of reasons, but I think gold just looks like it's hitting new highs. Frankly, for me, gold. Everybody, you get the gold bugs, everything. But if you match gold up with the stock market, they're basically running in tandem right now. So,
Mm-hmm.
you say, well, I want to own gold. It's a place to be. But at the same time, stocks are looking pretty attractive and breaking out. I mean, the charts look identical. It's crazy. Even a longer
Yeah.
term chart off gold and and in the stock market. And then the dollar index is basically looking at interest rates. So in kind of the idea that what future interest rates look like, and if they look lower, the dollar drops. And so you can look at that as a negative, but at the same time, that's a real positive move for a lot of our portfolios with any kind of international equity or any kind of exposure to other
Mm-hmm.
currencies and other markets. That's a huge benefit. We've got friends, clients in Canada, different places that, when the
Yeah.
dollar drops, it really, it's really positive for investments in other places. So look at that as a positive. And again, that's just, as interest rates, I think it's kind of following the interest rate idea of what's going to happen. You agree with that, or what do you
I,
think?
I do. I do agree with that. And I just want to add one thing with gold on this chart above here that, while it is trading near all time highs at this point, I think possibly one of the reasons could be just inflation in general. Again, the higher for longer thing. Yeah, and how Powell's saying, oh, we're going to, rates are staying higher for
Yeah.
longer. Inflation, we don't see it coming down to 2% in the next 12 months. It's going to be a longer term thing because we're going to do this slowly and thoughtfully. So he says that basically people are flocking to safety because people think, oh, gold is the best hedge against inflation. If inflation's going to run hotter for a little bit longer, gold's a good place to be, a good safe haven, right? So you get all the safe haven birds flocking in there. driving up the price of gold. So
Yeah.
again, just dating back to supply and demand.
You don't have a chart here on Bitcoin either, right? So the currencies, I think they had a big run today.
Yeah, you can show it if you want. If you've got
I
BTC
don't,
up.
yeah, I have the ETF, but yeah, I don't think we have to show it. But that's
Yeah.
interesting too that they moved also pretty strong to the upside today. That probably is not part of that. Might be the dollar weakness as well. So
Yeah.
anyway,
Yep.
yeah,
Absolutely. So let's finish off talking about. So what do we do? We've talked a lot about stocks, bonds, and something that we've talked about quite a bit is there's other ways to invest. And then we have an event coming up here on April 9th, a breakfast event here locally in Newport Beach. So if any of you listeners or viewers want to know more information about it, you can click on any links associated with this podcast. If you're watching it or listening to it online, you can go to boyerfs.com and contact us through there, or even give us a call as well, and we can give you the information completely free to you. Come learn some great stuff. But basically, our theme for it is innovative strategies for the modern era. Modern era meaning AI. AI is dominating. Bonds are acting like bonds again, but also spitting off a great yield in that core plus multi-sector. Even short duration is going to get some great yield and total return potential over the next year or two. So, what are some other strategies that maybe can kind of unhitch the correlation? Because stocks and bonds usually are opposite, right? They usually, one
most
might be doing better than the other. They kind of offset to create the all-weather portfolio, but they've actually acted in tandem recently.
well,
So,
yeah, and there's a lot of concern about that, right? I mean, it's
yeah,
like the 60/40 got absolutely blown up in 2022. I mean, when they raised rates so aggressively, the stock market, a couple of years back. I mean, they were just 40 years. It hadn't been 40 years since that kind of situation happened where you just raise rates, kills bonds, the inverse
mhm,
relationship, crush the bond market, and really, obviously hurt the stock market too. So in correlation, a 60/40 portfolio that's supposed to be kind of offset each other, just both both crashed
yeah,
and painful, especially for people that are already conservative, and trying to later in years, retirement, things like that. You're going to get crushed on both ends, and that was a one-off kind of deal. We've recovered a lot of that from the market's returns, and then stock bonds kind of appreciating off, because rates have dropped, come back down. And so we've talked in the past year about bonds, look good if the rates do come down. That's going to be very positive for fixed income again, and so forth. But to your point, what's interesting is in our, I've been in this market, in this business a long time. There's alternative investments they call, private equity,
hedge
hedge
funds,
funds, different things that a
private
lot of
credit. Yeah.
institutional investors, very large dollar investors, have been able to take advantage of in the past to sort of offset. They're still
Hmm.
doing stocks, they're still doing those things, they're doing fixed income too, but they've also had these other asset classes available to them due
Hmm.
to the size of the funds that they own, where they can take advantage of some really good income possibly, and some hedge against uh, a ballast, even further ballast to stock market and bond market returns. And
Hmm.
so what's kind of exciting nowadays is there's in recent years, there's a lot of ETFs and companies that have developed products that give you a chance to actually participate, like you have that type of money,
Yeah.
um, in alternatives, that make them part of a much smaller portfolio, to give you and us a chance to be a part of, take advantage of what, those types of folks have done in the past. Now they're kind of coming down to places where the normal people can do that as well. So those are sort of like what we want to talk about in our upcoming event, and some things that we've been looking into here a lot closer, and looking for places where that might be good fits for clients' portfolios. So I think it's an educational, there's some things out there, and that's our goal, to kind of provide education around there. Buffer ETFs, things that where you can explain it, but I mean, it's I don't want to do all the talking here, but where you're actually creating, almost, there's some products where you can actually create, where you participate in the upside, but if it drops, you get a chance to, you only lose so
Hedge.
much, or
Yeah.
it's kind of where the idea of the buffer comes from, which in my, my history, that was always sort of kind of a part of annuities and
Yeah.
insurance products that to me are very unattractive. I mean, completely unattractive, except for the fact that they're sold on fear of, well, what if, the markets
Yeah.
drop, whatever. And now it's interesting that there's actually some ETFs and some products that give you a chance to buffer just that outside of an annuity product, which I
Yeah.
think
And
is really,
liquid
yeah, more
investments.
in a more liquid form for sure.
Yeah, and
So anyway,
I want to put
yeah,
this disclaimer out there, just for us not getting in trouble for our listeners and viewers. So we're not soliciting any products here. We're just talking about an asset class that
yeah,
around from what we heard, we went to a private wealth forum, and this was something that was discussed because you look at think about the top 5 wealthiest families in your communities. A majority of them around potentially based off of surveys, 50% of their net worth of their portfolios or their investments are illiquid. So the whole premise of it was like, there's no need to fear like illiquidity. Liquidity is great. You should always have that available for short-term cash needs, investments. That's why stocks and fixed income funds can be great. But even if you buy the individual fixed income, usually you want to hold them to maturity unless
yeah.
you got some crazy
Look,
total return potential, right? So all of this being said is it's not a better way to invest. It's not a worse way to invest. It's
hmm,
an alternative way to invest, to decouple, to decorrelate. That's probably not the correct English, but to decouple from a traditional portfolio of stocks and bonds. And you've got your real estate, which is a great asset class as well. But again, this is just something that's different, that if we get a downturn, which after the year we've had, or a couple of years we've had really since 2020, markets have been positive. They took a turn south 2022 until late 2023. And then we've had a nice run from there, like I said earlier, all-time highs. So these are just ways to take down the standard deviation of your portfolios. So that way, if something, comes in the short term that we haven't foreseen, because again, we don't have a crystal ball, this is a nice way to maybe hedge on the downside because, uh, and Mark, you can attest to this or correct me if I'm wrong here. Okay. So let's say your portfolio loses 50%. You need to make 100% in returns to get
yeah,
back to square one.
yeah, absolutely. It's
You
just,
lose. So if let's say instead your portfolio loses 10, you only got to make 11% to get back to square one, right?
yeah,
So again, so just using the laws of mathematics and compound interest, these are great ways to limit downsides, or sorry, not limit, but what's the word I'm looking for here? Soften the downside of a portfolio, so that way you really don't have to be pedal to the metal and aggressive to try and force your way back to square one. You just let the markets and your diversified portfolio and time compound interest do its thing, the eighth wonder of the world.
yeah. And, and again, these products aren't necessary for everybody. And it's,
Mhm.
honestly, for me, like I'm learning more about it, moving there slower than maybe a young guy like you does. I want to make sure that it's the right thing for my clients and so forth. But it's really good to learn more about it and help people make their own decisions and whether they want to participate. Because it's just I think it's kind of cool that some things have happened to make these available. These types of alternatives. There's just these
Mhm.
alternatives that are now available to quote the average investor instead of the large
Yep.
institutional yeah, the big money, right? So it's kind of, anyway, it's
Exactly.
just interesting stuff. And yeah, it's more about that. But the key is diversification, and that's what we're talking about. I mean, I love the stock market right now. It is frothy. It's I mean, in the sense of people, it's up, it's gone up, it's been a big move. But you know what? It can go for a little while when interest rates are positive and there continues to be growth in earnings. Ultimately, that's what it'll follow the stock market. So all of them have their place. That's why you need a good diversified portfolio, because you just never know how it's going. Build a balanced offense. That's what we're trying to do with some defense thrown in. That's what we're.
Exactly.
That's where
Because
this
we know
other part comes
defense
in.
wins the championships.
Yeah, that's
So
spoken like a true defensive player.
yeah, baby.
Offense gets
Uh,
the glory, though.
that's true. That's very true.
Uh,
All right. Well, so if you want more information on any of this stuff, give us a call, shoot us an email, or contact us through our website. Always happy to discuss these things. But again, like Mark said, it's about balance, diversification, really catering portfolios to your needs and your goals. Because let's be real, people will ask recession, no recession. Oh my gosh, that's all. That's what the news. It gets clicks. But in reality, it doesn't matter what happens in the short term, right? I mean, it doesn't matter. Let's set yourself up for long-term success. Let's be smart with what we're doing and thoughtful in our approach. That's our job. That's our job, is to be smart, thoughtful, tactical, and listening to the client's needs, fears, wants, and goals. And that's kind of our true ballast at this point. Not, are we in recession? How can we recession proof a portfolio? That's not the goal. So that's too blanket statement. We're more personalized than that. But any last remarks, Mark, before we let the audience go here?
no, I mean, I can't think of it. You know, you and I we'll talk on future about the cash. You know, there's questions about all that cash on the sidelines, where it's going to end up, and maybe
Mm-hmm.
that'll be a future show. It's
Yeah,
yeah, it's a great time to be alive. There's a lot of exciting things going on, and yeah, it's a wild it's a wild
and
time. We got
around we go.
elections this year. It's crazy. I pray that we make the right decision with leadership, you know, going forward, and we need some quality. Yeah, it's gonna be interesting to see what happens there. So yeah, a lot of good stuff. I don't know. I don't. It's a great time to be alive. It really
Love
is.
it. Grateful for every day. Thanks so much, Mark. We'll see you guys next week. Have a good one.
See you.